Kenol Kobil now trading ex-dividend after declaring a 57 cents per share dividend last week. Now that dividend yield sitting at around 5%. That dividend for the interim period, in fact, as high as its final dividend for the entire 2010 year. How do you expect that stock to trade now ex-dividend?
I expect a slight dip maybe in the coming week. All the same, I think we might see support levels at about 10 shillings and 50 cents within the next couple of weeks. Kenol Kobil has been a fairly resilient stock. The company itself has very sound fundamentals. They have been doing really well. Their half-year results were really good and impressive. Looking at their marketing strategy, it has been impressive. And looking on, I think it's still a counter to be buying.
11 shillings and 15 cents. Should we not be waiting for it to go low then, as you say, to around 10 shillings?
It could go lower. I mean, we could wait and see the trend in coming weeks, but I would not put the support levels anything below 10 shillings. And still in the medium to long term, I guess it could trade way above the 11, 12 shilling mark.
Now, Kenya Airways, that company has been voted by an online survey by Nation Media Group as a company that Kenyans are most proud of. We saw some numbers coming out of that company for the first few months of this year showing that earnings were up and arrivals were up. They have aggressive expansion plans in the region. They're continuing to expand their fleet. They've stated they're looking to raise funds from the market in the next few weeks in order to fund further expansion plans. What are your thoughts on the airline going forward?
As far as the brand value goes, I think that is true. Kenyans always look at Kenya Airways as the national carrier. They have a lot of pride in it. And as we know, brand value is that extra shilling a consumer is willing to pay because they believe a company is doing well. And looking forward, they indeed have grown well. They have expanded into many routes. They still face a lot of competition regionally from the likes of Ethiopian Airlines. But locally, they still remain fairly strong. They have more or less a monopoly. They have bullied out the smaller players. And looking on at 33 shillings, 32 maybe, should be a very stable stock to get into.
Get into at this stage. How do you expect that the stock to trade in the coming week? It has been under some selling pressure in the past few weeks.
I still find it quite stable at the price it's at. And I think that price is really cheap. If you think about it, looking at the price to earnings ratio and looking also at the long-term prospects, goodwill from what they plan to do if they have a rights issue and raise more capital. So if I buy it at 30 shillings, if I was to buy it at 35 shillings, no big difference, because this is a stock which could well go above 50 shillings in the medium term.
Now, luxury hotel group Serena Hotels, that's one way to get exposure to the tourism sector through the markets. That stock rallied 3.6% on Friday to 57 shillings and 50 cents. That's on the back of strong investor demand from foreigners. But there are some concerns about how the debt crisis in Europe is going to weigh on current tourist arrivals to the country. Many in the tourist sector in Kenya are already saying that tourists are spending less money. Is this a concern going forward, and do you have exposure to TPS? It's
been a concern, and especially when we move toward an election year next year, we have a lot of aversion from the tourists. They find Kenya not being such a safe spot, especially considering what happened in the last general election. But then again, if you look at the numbers from last year up to this point, tourist traffic has increased. And also looking at the company we are talking about, the tourism promotion services, they have done a lot of expansion. Their revenues have been up, opened a couple of lodges in Elementaita. They have moved to Uganda. So I think the company still has a lot of value left they could draw from in these couple of months.
Would you be buying the stock then at 57 shillings and 50 cents?
I may not buy it at that price, maybe a bit lower, because we must remember they had a rights issue at 46 shillings. So 57 is about 10 shillings above that and may be seen as some as expensive.
So what are your stock recommendations for the week then?
I would go for the banks. I've always liked them for their stability and predictability. I would go for Barclays Bank. Right now is trading at an all-time cheap at 13 shillings and 45 cents. I would look at KCB. It's trading at a trailing PE of about 8 and dividend yield of about 6%, which is fairly high by all standards. From the industrial stocks, I would pick one of my favorites, Kenol Kobil and KenGen. The energy sector is still growing and there's a lot of room left for shareholder value.
KenGen still to report a full year numbers though. What are your expectations for that company?
I expect them to be good. I think they should be better than last year's. They have received a lot of funding for clean energy, for going into geothermal projects. They have already begun quite a number. They've been a very good dividend payer. Last time they paid 50 cents. The year before they paid twice, 90 cents and 50 cents. So this time round, shareholders may be looking to get some dividend value other than capital gains. So KenGen remains one of my best picks.
Just a quick comment on the shilling this morning coming in at the 93 level. Of course, we've had those moves by the Central Bank of Kenya to tighten liquidity in the market. And as a result, we've seen interbank rates spiking on the back of that. What are your thoughts on where the shilling will trade this week?
It's a bit hard to tell, but considering Central Bank has actually finally made some moves, they have tried to put some kind of fiscal straitjacket on the economy. They are reducing money supply, although questionable how they go about it. All the same, I think we might see support levels at 93. It could get worse. I think it may get slightly worse.
Some have questioned, though, the central bank's moves to use this new formula because we continually see those rates spiking. As a result, we could see short-term rates go higher. Is this a sustainable method to be managing liquidity?
It may be more of a short-term fix. Well, it's still a method nonetheless to try and create a balance between the cost of borrowing and the maturity, and also trying to reduce liquidity in the market in terms of cash flow. But looking at it from a general perspective, they may want to focus on fiscal policy, whereby they try and get more from taxation and try to reduce more when it comes to government expenditure.